Hello, greetings, and welcome to Dividend Blasters. My name is Bob. This is our 72nd video. Topic today, I'm a dividend investor. I have added a new high-income ETF to the portfolio. This ETF is managed by NEOS. NEOS is short for New Opportunities and Enhanced Strategies. This is a relatively new investment firm. They were founded in 2021. And the ETF is SPYI. So you know from previous videos that I have been investing independently for more than 30 years. Started out as a growth investor, morphed into a lot of dividend investing. Then last 7 or 8 years, I've been investing in a number of ETFs. I like the benefit that an ETF offers with risk diversification, and I like the fact that I can get some decent dividends out of them. And I started off with some of the core index ETFs like VOO and QQQ, then ultimately QQQM. And then I got into dividend ETFs like SCHD and DGROW. Then the industry evolves and we find ourselves investing in wonderful income ETFs like JEPI and JEPQ. Well, this may be something that turns the page a little bit in dividend investing, income investing, I'm going to call it, SPYI. And I got to tell you, I'm going to do a little deeper dive here, but let me first answer the question, why am I adding a new ETF to the portfolio? And it's very simple. The answer is cash flow. I want to generate more cash flow from my investments. And most of my investments, I have an auto drip turned on. So everything goes right back into the holdings, whether they're stocks or ETFs. This one's going to be a little bit different. It is a little bit different. I do not have auto drip turned on. It's going to be manual for me. I am taking the distribution, the cash, and I'm going to do one of three things. One thing I could do, and I haven't done yet, is I could turn the auto drip on and just drive it right back into the holdings. So haven't done that yet for this. This, to me, is going to be a cash flow generator for my portfolio. And I'm going to be using that cash for either one, redeploying across the portfolio into other investments, or two, building my cash reserves. Why do I want to build cash reserves? Well, first of all, it's better to have more cash than less cash. But you know what? Even more pointed than that is we want to be prepared for market downturns. We want to be prepared for downward disruptions because those, for us, are buying opportunities. If a price goes down, doesn't mean that the stock or the ETF is bad. It just means that the price has gone down, and that's a buying opportunity. So I want to be ready for that. And that, to me, is what SPYI is going to do for me. Quick disclaimer, I am not your financial advisor, so what I say is not financial advice. It's not tax advice either. I'm going to talk a little bit about taxes. So the purpose of this video is for information and education. It reflects my own personal opinions, research, and experience as an independent investor for more than 30 years. So please do your own research, consult a financial advisor prior to making any financial decisions. Let's jump in. So if you follow me on other platforms on social media, you may have seen this. I've posted on Instagram, Facebook, and X. It really just shows two of NEOS's ETFs side by side. Full disclosure, I've invested in both of these, but I'm only going to talk to you about SPYI, and I'll tell you why. QQQI is a very new ETF. They were just founded earlier this year. I'm still watching it. I'm collecting data. I actually have a little bit more invested in SPYI than I do in QQQI. I like what I see. You can see the skinny there for both of them. But anyway, I'm going to talk more about SPYI. And so, what is the skinny here? The skinny is that SPYI is an actively managed ETF. Okay, there are folks there that are actively managing. How are they doing that? They're writing call options, and they're doing that to generate premiums that they can collect and turn into income for us. So when we get our distributions, we're getting more than just the dividends that they're investing in the index. We are getting a piece of those premiums. All right. What index is this? It's the S&P 500. They're investing in stocks. They're investing and they're writing call options against the index. So that's what they're doing. QQQI is really the same thing, except it's the NASDAQ 100. But anyway, back to SPYI. It's trading as of yesterday, Friday the 28th, $50.50 it closed at. It's close to the top of the 52-week range. Expense ratio is 0.68%. So it's a little bit pricey compared to some other ETFs like your core index ETFs like a VOO or an SPY. Even more expensive than maybe an SCHD, which is your dividend growth ETF, which is a 0.06%. And a better comparison would be a JEPI or a JEPQ. JEPI, really, 0.35%. This is 0.68%. So it's a little bit more expensive. However, I have seen ETFs with even more expensive expense ratios. What are we getting for this? We're getting the active management of their team. And 0.68% is equivalent to paying $68 a year in management fees on a $10,000 investment. It's not significant. It's just, you look at the dollars and the cents and you make a decision. Is this something I'm willing to pay? Or would I be better off paying $3 a year in a VOO or an SPY? So anyway, or $35 a year in a JEPI or JEPQ. The difference here is that you are going to be getting a higher distribution. You're going to get that cash, that additional cash flow from SPYI. How do we know that? Look at the distribution yield. The distribution yield currently is 11.63%. JEPI is less than that. That's in the 8 or 9% range. It has been higher in the past, but not this year, not lately. That is a very generous distribution yield. Like JEPI or JEPQ, it's a monthly distribution. They have a growth streak of 1 year, and it's a very nice growth streak percentage. It's only 1 year. And with these covered call ETFs, it's hard to expect to have a dividend growth streak because it really depends on how they do with the call option strategy. So that is pretty nice to see. I went ahead and, first, before I talk about the Patty, you can see how they compare to the S&P 500 in the price return and the total return. The total return is much higher here than the price return, but the total return is approximating what the S&P 500's return is. That to me shows me that they are doing a really good job of managing this ETF. Now, to the Patty, the projected annual dividend income, I went ahead and I did a calculation, and given a $10,000 investment, you can expect to get about $1,176 in distribution on an annual basis. You're going to get that every year, all the time? No, but that's what it would be today, annualized. And you know what? You can see QQQIs. They actually have, and let me just say, SPY has been around about 1 year and 10 months. QQQI has been around about 5 months. They just paid their 5th monthly dividend, but right now they have a distribution yield of 14.5%. It's even higher. So that's something to watch for. These are very generous distributions. Okay, let's press on. This comes from their website. It's a fact sheet. You can see SPYI and QQQI here. Basically, what I said as far as monthly paying and the distribution yield and the expense ratio. There's a couple of other ETFs that they have. One is more focused on T bills. The other one is focused on bonds. And there's another one that they just started, uh, and it is focused on the Russell 2000 index. That's very new. So something to think about if you're looking for smaller or mid cap type investments, to take a look at that. So I want to take a couple slides here just to talk a little bit about Neos's underlying philosophy. So they're in the business of maximizing your return. They also want to minimize your tax liability. And you often don't hear folks talk about that. You just kind of like accept the fact that I'm going to be investing in a um, covered call ETF. It's going to have I'm going to be generating more income. Unlike growth investors, they are not going to pay any taxes unless they sell and have to pay capital gains. We, as a dividend investor, are going to be paying, you know, uh, taxes on our distributions. That's basically income. Are they going to be qualified, or are they going to be taxed at a lower rate, or are they going to be ordinary and taxed at the rate that we pay our income taxes at? This here is interesting because these guys have a strategy where you can reduce your tax liability based on the distribution that you get. And the distribution that they are giving you is classified a little differently uh, than most ETFs. Most covered call ETFs, when you get your distribution, they talk about what's your return on invested capital. What's your return on capital? Okay. What they are calling it and how it's classified by the tax law, it's a return of capital. That's fascinating. Return of capital. It's a little bit different. I'm going to share with you what I've learned from my research here. And this comes right from their fact sheet from the website. A return of capital, it's a distribution made by the ETF to the investors. It's classified as a return of the original investment. Unlike dividends or interest income, return of capital is not considered income and thus is not immediately taxable. Wow, that's kind of mind blowing. So instead, it reduces the investor's cost basis in the ETF, which can potentially reduce the amount of capital gains tax owed when the investor sells their shares. Return of capital is useful for ETFs that use option writing strategies to generate income. Fascinating. So, return of capital can help lower an investor's current tax liability by reducing the amount of taxable income that an investor receives. The return of capital can potentially reduce the amount of taxes owed in the year the distribution is received. I get this. I want to see this in practice. So I haven't had this for a year. I haven't been through a full tax year, but I do have a decent amount invested, and I like what I read. I like what I'm hearing, and this is especially favorable to investors in a high tax bracket. Okay, that's all good stuff. It can help you manage your cash flow needs. So by returning a portion of the investor's original investment, the return of capital can provide investors with a steady stream of cash flow without requiring them to sell their assets. I love this. Okay, because you know what? When you are, and this kind of gets to the last bullet, when you are retired or you're approaching retirement and you are not working or you're working part time and you're dependent on passive income, the last thing you will need to do or that you should do is sell your assets. You don't want to sell those. That's your bread and butter. That's where you're getting your passive income from. So I love this. We'll do a little deeper dive here in SPYI. So, what I particularly find fascinating, um, and what I shied away from these covered call ETFs when they first started coming out a number of years ago because of NAV depletion or NAV depreciation. When you are getting these high distributions out, um, that's part of the asset's value. So you're taking it out in cash, but the price is going to be reduced effectively, um, because the cash is coming out. What is happening here is these guys appear to be doing a really good job of maintaining the underlying net asset value. And you can see the return relative to the market price. So if you look at that table in the middle for the 1 month, the 3 month, the 6 month, the year to date, the 1 year, and the since inception, the inception to date time frame, the NAV is very close to the market price. If you see, for instance, a big spread between the two, you'll know that there is significant NAV depletion. Here, that's not the case. It is not the case. So I like to see that. I think that that's great. So I wanted to share that with you. We don't see this in a lot of other ETFs. So that is for your information. Underlying holdings, the top 10, no surprise here. You saw that on the earlier graphic. Microsoft, Apple, Nvidia, Amazon, Meta Platforms. So there they are. And these will change periodically, but there they are. I also leverage Seeking Alpha. It's really my independent source, as you know, for a lot of my analysis that I do. You can see that the year-to-date price appreciation for SPYI is a little over 4%. Again, if you look to the right, the assets under management are about 1.5 billion. It's a very small, um, ETF, relatively speaking. However, I would not be surprised to see an influx of capital come in from investors, and you're going to see those assets under management just mushroom. That's my prediction. The expense ratio is 0.68%. A yield, 11.75%. It's a very decent yield. The forward rate, well, actually, it's a trending 12-month rate, $5.89. I can tell you that looking forward, I would expect it to go above $6 a year, and then some, but we'll see. Just some basics on the fund profile here. And you can see the breakdown by sector, market sector. Obviously, the top three holdings are in the tech sector, Microsoft, Nvidia, and Apple. Then followed by financials, which is much less, about a third of that, and then healthcare. And there they are by companies. Okay, so number 4 is Amazon, Treasuries, Meta Platforms. And then you got Alphabet, Class A shares. What I love to see is that Seeking Alpha has given SPY a dividend grade of an A plus. You don't see that a lot. You see that in some ETFs, but an A plus is pretty impressive. Now, again, they've only been around 1 year and 10 months. So you really can't do a dividend growth rate for an extended time horizon. But they're giving them a grade of B. But look at what that trending 12-month dividend growth rate is. That's really just the last 12 months. It's 23.5%. That is pretty high. Now, I would anticipate that that'll come down. It'll normalize a little bit. But, to see a growth rate in a covered call ETF that high for this short time horizon is really quite impressive. How do they compare to other ETFs? Well, they blow them away. So you can see them right there. The median dividend yield is about 2.61%. The median dividend growth rate is about 11%. 11% is pretty good. 23% is amazing. And if you look at the scorecard, I already mentioned it's about $5.88-89 dollarized rate of the dividend or the distribution yield. The percentage is 11.75%. Well, just got a distribution yesterday, Friday, June 27th. And again, this is monthly. That is a very nice thing to have. I like to get that monthly distribution. Here is the dividend history in bar chart form. What I like to see is that it's fairly flat, it's stable. Of course, we like to see it go up, so an upward slope. We don't see a lot of disruptive spikes here, which is great. And then here it is in table form. And you know what? So if you look at 2022 and then moving up to 2023 and 2024, they're basically, you can see slight increases. 2022, it's mostly in that 46, 47 cent per month amount. And then in 2023, you see 48 mostly, 48s and 49s. And then 2024, you're mostly in the 49 and 50 cent range. So it's pretty much moving up. And I like to look at the raw data. That makes me, I'm a kind of a data geek. It gives me a nice feeling. So what this shows us is just the delta or the variance between the price return and the total return. It's a significant amount. And this is good to know because if you're doing what I'm doing, at least for now, you can see the difference. That difference is, and this is a 3-year time horizon, but it's really 2 years. It's a difference of about 20% or so. That 20% is going to be the cash that I'm going to redeploy or build up cash reserves. And you can see how they compare to the S&P 500. They're really about the same total return. And this is for the 3-year time horizon. And again, they don't have 3 years. You got a little less than 2 years. The purpose of this chart is to show you how they stack up against JEPI. And they're actually outpacing JEPI. JEPI is about 22.3% total return for 3 years. SPYI 27.31%, even a little bit more than the S&P 500. Now, I also subscribe to Market Beat. This is a fine resource, and what I get out of this, it tells me in a nice distilled analysis what the consensus price target is for a lot of these investments, and they're telling me that the price target, the aggregate price target, is about $52.56. And it's trading right now, as I mentioned, for a little over $50. So that translates to about a 4% upside. So, and if you can look at the far right, you can see most of the analysts, the professional analysts on Wall Street, are rating it as a moderate buy. There's a couple of folks that want to hold it. Nobody wants to reduce or sell, and another analyst wants it as an outright buy, essentially. So there you go. This is useful because this basically gives you a sense of the capital inflows and outflows into NEOS for this ETF. By far, the inflows are outpacing the outflows by a factor of almost 100. So 111 million versus 1.88 million. You can see the number of institutional investors. It's a factor of 35 to 8. So more investors are going in than are coming out. And I find this to be instructive. And you can see the trends of incoming or inflow of investments. They have increased in Q4 versus Q3 of last year. We can see Q1, it's slowed down a little bit. I will be very interested to see how Q2 does, but Q4 was very hot. And here's the skinny again. You can take a closer look at this. I'm not going to cover this again. You've seen it. You can freeze the screen and take a close look. I will say this, that I like SPYI. I'm glad that I've added it to my portfolio. I've stuck my toe in the water for QQQI. but I do like what I see. I like that distribution. And so I'm going to be watching. Really, to me, I'm going to be watching the stability of the dividend or the distribution. I want to see a steady distribution, flat or maybe slightly up, but I'm going to be watching it closely. And if I see that, I will probably uh, redeploy some of my cash into QQQI. But right now, I'm in there just a little bit. And folks, that's it. I thank you for joining me today. I hope you found this to be informative and enjoyable. And if you have, give us a like, share the video with a friend, hit the notification bell, and we'd love for you to subscribe to our channel if you would. Check me out on other platforms. You can see me on X, Instagram, Facebook, and Threads. All Dividend Blasters or at Dividend Blast 99 on X. Look for the blue check mark. I'm profile verified on all those platforms. And I'm here on YouTube. And my handle is at dr.finance6447. And you can email me directly at drfinance999@gmail.com. I do want to close by saying I am a long-term subscriber to Seeking Alpha, but I'm also a recent new partner and affiliate. I swear by this. And when you join Seeking Alpha, you're really joining an army of like-minded investors and a massive amount of expertise in the business. You have access to the latest prices, quotes, metrics, and you have robust qualitative and quantitative analysis all at your fingertips. I tell you, I don't make any new major investments without leveraging this. And I can tell you that as an affiliate and a partner, I have the authority to offer you a discount off your first year as a member. 20% off. So normally you'd pay $239. You can get first year for $189. Additionally, you can get the first 7 days for free. If you don't like it, cancel. But I think you will like it. Give it a shot. The link is below. I'm also placing the link in the comments. So you can go ahead and click on that link if you're interested and subscribe. I already mentioned that I'm on different platforms. You can see them there. And I do want to give a shout out to some of my colleagues who I collaborate with on Facebook and X, primarily Dividend Snowball. Dividend Snowball has a great discussion group on Facebook. Some of the greatest thinking, cutting edge thinking, especially on cash flow ETFs, high dividend income ETFs. Some of these guys are extremely innovative, and I love just collaborating with them and listening to them. So check them out. Check us out too over at Dividend Blasters on X and on YouTube. Look for my blue check. Check out Dividend Snowball. Also, check out Dividends R Us. It's a very large group on Facebook. They're also on X. A lot of smart people, a lot of great information sharing. And then also Saving and Investing for Beginners, another large group. More than just dividend investing, basically a lot around investing concepts for beginners, also good primers on the markets. So check them out as well. And folks, that's it. Have a wonderful day until our next video. God bless.